we have quite a significant US military buildup in the region, which, as Amos Hochstein suggests, really sends a signal about what the United States is considering here. Dan, if we saw these US-Iran tensions actually escalating further, what is the realistic worst case for energy markets, and how quickly could prices react? Yes, we're seeing crude pull back today. Any thoughts on why?
Yeah, I think that we think about the worst case, which means upside price levels. In a region where 30 million barrels a day is produced within 500 miles of a border of Iran, 20 million barrels a day flows through the Straits of Hormuz. That would be a significant disruption to oil markets, and prices go to triple digits. You could have WTI at $100 a barrel. And so I think that that's a significant change to the market. It's also something that we didn't see during the June conflict, and it's really at odds with what the Trump administration has talked about in terms of affordability and cheap gasoline and keeping WTI closer to 50. So I think if you look at the affordability issue, you'd probably say that this is more talk than action. But you also have to be prepared for whatever comes and however the Iranians react.
Indeed. Dan, you mentioned the Strait of Hormuz, and we often talk about the Strait of Hormuz as a tail risk in the region as well. When you look at the current price action, do you think markets are underpricing the risk around the Strait of Hormuz right now, or is a potential escalation around the Strait already being fully reflected in the price?
Well, the way I think about it is oil is probably a $55 commodity if there is no action in Iran, and if there is, it's a $100 commodity. You put all that together, and it says there's a 25% probability that something happens. That feels a little bit high to me, frankly, because one has to be conflict, and then that conflict has to result in sort of embroiling the whole region. We haven't seen that in 30 years. And so it is a tail risk. I don't think it is a front and center risk. And so 25% odds feels a little bit high to me at this point, frankly.
Dan, let's talk about the current price action as well, because we've just seen WTI dipping below $65, but still on track for its best month in nearly 2 years. January has been great for the oil markets. How much of this rally is on fundamentals and how much is on geopolitics?
I'd say that it's about a third fundamentals. We had the CPC pipeline come down, Kazakhstan production below expectations during January. That's the 1/3. The 2/3 would be the tensions pre-conflict with Venezuela and the seizing of tankers, and then what we've seen recently with Iran. So I tend to think 1/3, 2/3 fundamentals and geopolitics. And if the geopolitical doesn't play out, this 20% rally we've seen in crude could probably reverse itself fairly quickly.
Right. And of course, it's not just the geopolitics and the geoeconomic backdrop. It's also the fact that we've seen the US dollar sinking through the month of January as well. To what extent has a weaker USD driven the more recent crude price gains?
Yeah, I think it has to be part of it. The calculus around commodity price is always tough. You've seen the weak U.S. dollar support a lot of commodities. Oil has been lagging because it's so fundamentally oversupplied, but I do think it's mattered to the equation. So I think you have to put that into the picture with Iran. You've got to put it into the picture with what happened with barrels offline in Kazakhstan. I would say the bigger issue is that with no geopolitical disruption, we're simply oversupplied, and even with a weaker dollar, it feels like oil's heavy here.